Today, we're diving into a topic that physicians often avoid but can't afford to ignore: debt and financing for medical practices. If the very mention of debt makes your stomach turn, you're not alone. Most physicians are naturally conservative when it comes to money, and understandably so. You've been trained to avoid risk, to make decisions based on data, not gut feelings. And let's be honest, medical school didn't prepare you for amortization tables or capital structure discussions. But here's the thing: avoiding debt doesn't mean avoiding risk. In fact, in some cases, avoiding financing might be the most expensive decision your practice can make. Welcome to Medical Money Matters, the podcast where you can find experts, answers, and resources so that you can achieve mastery over the financial and business aspects of your practice. Hello, everyone. I'm your host, Jill Arena. I began my career in accounting and finance, and I have more than 30 years of experience running medical groups. I own and operate a national healthcare consulting and revenue cycle company, and I am the author of Physician Heal Thy Financial Self. In 2020, I co-founded the Physician Leadership Project, and in 2025, I released Physician's Edge, the first of its kind online business education for physicians. My passion is to increase financial and business literacy for physicians. Episode 151, Credit Where It's Due: Managing Debt and Financing for Medical Practices. Debt makes most doctors nervous, but what if avoiding financing is actually holding your practice back? Welcome to Medical Money Matters, the podcast where we tackle the intersection of medicine, money, and management, helping you run your practice like the business it is. Today, we're diving into a topic that physicians often avoid but can't afford to ignore: debt and financing for medical practices. If the very mention of debt makes your stomach turn, you're not alone. Most physicians are naturally conservative when it comes to money, and understandably so. You've been trained to avoid risk, to make decisions based on data, not gut feelings. And let's be honest, medical school didn't prepare you for amortization tables or capital structure discussions. But here's the thing: avoiding debt doesn't mean avoiding risk. In fact, in some cases, avoiding financing might be the most expensive decision your practice can make. Today, we'll explore what financing options are available to medical groups, break down the difference between debt and equity financing, and help you think clearly about when and how to use capital as a strategic tool. By the end of this episode, you'll have a framework for making smart financial decisions that support both the clinical mission and the long-term stability of your organization. Let's start with the mindset piece. Physicians tend to be risk-averse. It's baked into the profession. You were taught to follow protocols, reduce variables, and protect against worst-case scenarios. When you transfer that mindset into practice ownership, it often shows up as a deep reluctance to borrow money or bring in investors. You'd rather pay cash, or delay an investment, or scale back a vision than take on a financial risk. And on the surface, that sounds reasonable. After all, who wants to be saddled with debt or give up equity if you can avoid it? But here's the catch. By refusing to engage with debt instruments or financing, many practices put themselves in worse financial positions over time. They delay necessary upgrades. They stretch staff too thin. They pass on growth opportunities. They even burn out providers because there's no budget to hire more help. Risk avoidance becomes a different kind of risk, a quieter one. And that's what we're here to unpack. There are a lot of reasons a medical group might need capital. Maybe you're starting a new practice from scratch. Maybe you're expanding, adding a second location, hiring more providers, buying equipment, or launching a new service line. Maybe you need to upgrade your EHR, rework your front office, or install a phone system that doesn't drop calls all day. Or maybe things are tight. A payer contract changed, a big claim was denied, cash flow is uneven, and you need a bridge to get through the next 90 days. All of those scenarios require capital, and capital, in most cases, means some form of financing. Let's start with debt. Debt financing is when you borrow money, usually from a bank or lender, and agree to pay it back over time with interest. This can take several forms: a traditional term loan, a line of credit, an SBA loan, equipment financing, or even real estate lending. The major upside of debt? You keep control. You don't have to sell shares or dilute ownership. The money is yours to use, and as long as you make the payments, the lender doesn't have a say in how you run your practice. Another benefit? Predictability. You know what your payments are. You can model them into your budget. And in many cases, the interest is tax deductible. But debt also comes with pressure. You have to repay it, whether or not your new provider ramps up on time, whether or not your patient volumes meet projections, whether or not your payer mix changes. If your cash flow is tight or your revenue cycle isn't stable, debt can strain your operations. And depending on the lender, you might be required to personally guarantee the loan or put up assets as collateral. That's not always a deal breaker, but it's something you need to fully understand before you sign. Now, let's talk about equity financing. Equity financing is when you raise money by selling a piece of your practice, either to internal stakeholders, like new physician partners, or to external investors. In smaller or independent practices, equity often means admitting a new partner. That partner brings capital and in exchange receives ownership and a share of future profits. There's no repayment obligation. You don't owe interest. Instead, you share future earnings and decision-making rights. Equity can feel safer than debt because there's no monthly payment. But make no mistake, it's not free money. You're giving up control, and in many cases, that trade-off lasts forever. Let's say you sell 10% of your practice to raise $200,000. That might feel like a win. But 5 years from now, that 10% of the practice might be worth $500,000. That's the cost of equity. It's the value of what you gave up. It also changes your governance. Every new owner brings their own opinions, goals, and priorities. More voices at the table can be helpful, but it can also slow down decisions or create friction. And if you bring in outside investors, say from a private equity group, the cultural impact can be significant. Suddenly, you're not just running a practice, you're part of a portfolio. The focus shifts, autonomy fades. Decisions may no longer be made purely in the interest of patients or staff. So neither debt nor equity is inherently good or bad. They are tools. The key is understanding when to use which and how to evaluate the trade-offs. You're listening to Medical Money Matters, a weekly podcast brought to you by Healthy Practices, a healthcare consulting and revenue cycle company dedicated to keeping our clients independent. Please reach out if we can do anything at all to support your practice. You can find more information online at healtheps.com. That's www.healtheps.com. Please follow or subscribe to get all future episodes downloaded as soon as they're released. One of the most common equity versus debt decisions practices face is internal growth. Let's say your practice needs $500,000 to build out a second location. You have a few options. Option 1, take out a loan. You repay it over 5 or 7 years. You keep full ownership and control. You take on all financial risk, but you retain all future upside. Option 2, bring in a new partner. They contribute $500,000 in exchange for 20% ownership. No repayment, no interest, but that 20% of future profits and decision-making rights are gone permanently. Option 3, do nothing. Delay the expansion. Hope the opportunity is still there next year. That last one is the most dangerous option of all, and it's the one that most practices default to. We see it all the time. Leadership teams sit on expansion plans for months or even years, paralyzed by fear of financing. Meanwhile, staff burn out, patients leave, referrals drop off. The community grows, but the practice doesn't. Eventually, the opportunity is lost. So how do you choose the right path? Start by asking, what's the goal of the capital? Are you trying to solve a short-term cash flow problem? Then a line of credit might make sense. Are you investing in long-term growth, like a new service line, location, or provider? then debt or equity might be appropriate depending on your cash flow, risk tolerance, and leadership structure. Next, assess your financial health. Is your revenue cycle stable? Are your margins healthy? Do you have strong collections and clean claims? Financing only works when you have a solid foundation. If your billing is a mess and your expenses are out of control, adding debt won't fix the problem. It will make it worse. Then model your scenarios. What does it look like if the new location hits 80% of your forecasted volume? What happens if it takes 6 months instead of 3 to ramp up? Can you still make the loan payments? Will the new partners still be happy with their return? Understand your break-even point. Know your fixed and variable costs. Think in terms of best case, worst case, and most likely case. That's what smart businesses do. And most importantly, don't make those decisions alone. Work with a financial advisor. Talk to your accountant. Partner with a group like Healthy Practices that understands not just the numbers, but the unique realities of running a medical practice. We help you model scenarios, evaluate options, and make decisions that align with your mission, your values, and your growth trajectory. Financing decisions shouldn't be made in isolation. They touch every part of your business, your governance, your provider relationships, your staffing, your operations, and your culture. And let's be clear, doing nothing is a decision too. And it has a cost. The cost of deferred growth, the cost of missed opportunities, the cost of burnout and turnover, the cost of falling behind in a competitive market. So if your practice is facing a capital need, or if you've been sitting on an idea for growth that keeps getting pushed to next year, ask yourself, what's really holding you back? Is it fear, uncertainty, lack of information? All of those can be addressed. What can't be addressed is time lost. As we wrap up, let's recap. Debt financing helps you retain ownership, but requires careful cash flow planning. Equity financing avoids repayment, but dilutes control and long-term earnings. Both options can be smart if used with intention. And avoiding both out of fear or uncertainty can be the most expensive move of all. If you're ready to explore financing options, or even just want to talk through a what-if scenario, reach out to us at Healthy Practices. We can help you model out the options, understand the costs, and build a plan that supports your goals, not just for this year, but for the long term. Thanks for listening to Medical Money Matters. You deserve a practice that's not just clinically excellent, but financially strong and strategically sound. Don't fear the debt, understand it, use it wisely, and keep building a practice that lasts. Until next time. Podcast outro. Physician, heal thy financial self. Thanks for joining us on the Medical Money Matters podcast. Ready to take control of your practice's finances? If you're just beginning, grab your copy of my book, Physician, Heal Thy Financial Self, available now on Amazon. It's packed with actionable insights to transform the way you think about your practice's finances. Also available in Kindle and Audible formats. Visit healtheps.com, click on Products and Books to get started today. Until next time, take charge of your financial future and keep your practice thriving. See you on the next episode of Medical Money Matters.